With the market already pricing in a 0.25 percentage point cut, my next guests are now focusing on the potential end of quantitative tightening. So joining us now are Michael Schumacher, head of macro strategy over at Wells Fargo, and Ross Mayfield, investment strategist over at Baird. Thank you, gentlemen, both for being here. Michael, we're going to start with you. This is probably one of the more telegraphed rate moves that the Fed has seen, and the markets are playing it that way as well. What exactly do we need to see or hear from the Fed later on today with regard to what the next steps are for Wall Street?
Yeah, Dom, it is telegraphed. I agree with that. And it's not simply because you've got this move just about baked in, but there's been effectively no economic data for the last month. So nothing really to change the Fed's mind in terms of the path. What people are focused on is the balance sheet. Is the Fed going to announce that today is the day the Fed stops running it down? Probably not, but it may actually do it for forward start. So it might do this for December 1st or something like that. I think the big surprise to the markets would be if the Fed said, no, we're good. We'll just let the balance sheet run down a bit more and we'll evaluate next meeting. That would be a shock.
Michael, we've spoken now for a decade and a half about rates. And every time we come to you about questions on rates, you give us these very simple and simplistic answers that kind of clarify things for us. So for our viewers out there, what exactly is the most important thing for rates in the next, say, 6 to 12 months?
I think probably the most important thing for rates is really, I'm going to say two things, so not just one. But number one is, what's the evolution of all the tariff discussion? The tariff hit on the U.S. economy has been less than I expected, less than a lot of people expected. If we go back to April 2nd, Liberation Day, and say, would the U.S. economy, would we have expected it to be in this great shape? Probably not. So does that continue, or is the tariff hit simply delayed? That's the first thing. And secondly, how do people at the central banks like the Fed react? So right now, I'll give you an example. The market expects the Fed to ease about 100 basis points more, putting the funds rate down to about 3%. Does Powell endorse that idea today? Does the Fed really follow through in the next few months? These are the big things people need to weigh over the next, call it, 6 to 12 months.
All right, Ross, from an equities perspective, how much is the rate picture necessary for the next leg hypothetically higher in the marketplace?
Look, I think it's a leg that the bull market stands on, but it's not the main one, right? We know the AI trade is primarily fueling this. Now, there is a lot of easing baked into the market. So I think on one hand, the idea of lower interest rates, sparking some of the cyclical corners of the market, the housing trade, for instance, is important, but it's also baked into the market. I mean, we look at Fed fund futures, and again, 125 basis points more of easing, plus the end of QT, which is more, easing of financial conditions. So it's clearly a big part of this. We don't have a lot of data points, but Fed rate cuts plus no recession has been a very potent mix throughout history. And I think we're sitting there today, but it's far second to AI and the developments on the front of the Mag 7 and some of the other players in that space.
And Ross, how important is that balance sheet policy or clarification on policy going to be for those equity markets?
Maybe important on the margins. I do think, if Powell were to come out and surprise the market by saying that we're just going to keep letting the balance sheet run and continue quantitative tightening into perpetuity, I think it might be a bit of a shock to equity markets. We've seen some stress in short-term funding markets. I think that's actually the impetus for Powell to maybe pull this QT end forward into today. But if we're looking out long-term as to what matters, I think in addition to tariffs and to how the Federal Reserve reaction function works, we're looking at inflation. I mean, we've seen inflation come down, but we've also seen inflation ex shelter start to tick up month over month for the last several months. So there's this stickiness to inflation that I think will probably keep the Fed from cutting anywhere past their neutral rate. And I think so then you start to think about 2027, where does the Fed end up? And that's a much more interesting, I think, thought experiment, because 2026, I think, is fairly well laid out by the Fed.